Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here at Trading Capital. Jumping into the charts on this September 2nd. So we close off yet again another week in the major markets and indices, and what terrific price action it was today. So overall, on the session today, the S&P 500 actually finished down. Yet again, another down day on Wall Street. And one can argue that, we were off to such a brilliant optimistic start. And you can see that this is yesterday's rally and the close pretty much at the highs. After hours trading, and this is your pre-market trading, where you had a little bit of gap up, power move in the pre-market session, and then the market still continued to surge. When the markets opened, they had a little bit of a dump, and then they continued to surge, made a new high. And this is where it got really interesting as a trader. And this is why you have to watch the intermarket connected analysis, incorporating many different sectors and currencies and markets into your analysis will give you the best options at knowing where the price action is likely to head. Not a guarantee, but likely. And that's all we do in this business is probabilities and position management. If you are right more times than you're not, with effective position management, you're going to make money in this market. And that's certainly what we've been doing this year. So what I'm going to touch base on in this video is the S&P 500, the NASDAQ, of course the two major indices, and then we'll touch base on the dollar and how they've both been correlated directly to the dollar. And then we'll look at gold and the interest rates as well, yields. So starting with the S&P, massive power rally early on and then a huge dump. Look at this, 1, 2, 3, 4, 5, 6, 7 bars, a little bit of bounce, power move dump, and which continued and continued and continued. A little bit of a bear flag consolidation, this chop here, which triggered and broke. Now, the interesting thing about this type of price action is notice how early on in the day we rallied and then in the afternoon we sold off. This is directly correlated to the US dollar. If we flip to the intraday action in the US dollar, let me just remove some of these trend lines. But the intraday action on the US dollar was, we actually started right over here. So this little gap over here. We gapped down and the price action of the dollar just continued to sell, and grind lower. Few bounces in between, but making a series of lower highs and lower lows. Until you reach this point down here, the US dollar had a massive bid and rallied. This was the point in the S&P where this automatically started selling. So you can see it's pretty much an inverse move of the dollar. Massive sell, massive rally. That's the power of noticing correlations and understanding how markets react when certain things reach critical areas that are going to generally break something if they stay sustained at these levels. It was kind of also like when oil reached $120 a barrel. The market only cared about what oil was doing. Oil was the leading energy commodity at 120, and every time oil would uptick, the markets would downtick. Obviously, energy stocks excluded, but as the dollar is upticking these days at these levels, the markets are downticking, and vice versa. If the dollar falls, the markets love it. So why I'm kind of short-term bearish on the dollar, but medium and long-term still bullish on the dollar, and that's the type of time frames. Time frames are the most critical aspect to being a trader, a swing trader or a day trader, is understanding time frames. And in and amongst the three time frames, there's kind of subsections of time frames, but you have the minor, which is the short term, you have the intermediate time frame, which is the medium term, and then you have the major. And in and amongst those three time frames, you can have subsections of the time frame. So not to overwhelm people along time frames, but understanding the time frames as a trader will give us the best outcome and the highest probabilities of seeing our positions profit for us. So why I'm bearish on the dollar? But first of all, why did we get this bounce in the dollar here? Was there any news? No. Was there anything that people knew ahead of time? No. If you simply take a trend line and you take this pivot and you draw it all the way through there, you can see that you've connected pivot to pivot to pivot. The dollar simply found support by hitting off of that trend line. Boom. And what a beautiful, beautiful hit of that trend line it was. To a T, it kissed it, tagged it, and you had this massive rally. And since we knew the dollar was coming into a little bit of an oversold state in the short term, this is where we actually decided to exit a lot of our day trades that we were holding and some of our swing longs. But up until we reached this gap fill over here, that's where we started to accumulate long positions. So again, we're kind of just moving inversely to the dollar, but we hit this gap fill, failed to confirm above it. That's where I knew price action was in trouble. Now, one of the interesting things about the dollar is that one of the reasons why I think we're at a short-term top is if you simply take this trend line and draw it across, you can see we tag the dollar. You have this pivot here to this pivot over here, this chop, which you've never really confirmed above on the intraday basis, and then you tag this pivot over here to a T. And you're clearly at resistance now for the dollar once again. And if we flip to the 2-hour chart, one of the interesting things about this chart and what I was watching intraday is we put in this beautiful reversal daily topping, or this 2-hour topping tail. So it's a semi-long time frame on an intraday basis. Doesn't hold as much weight as a daily candle, but 2-hour formation certainly holds some validity in the short term. So this is one of the reasons why I think the dollar is going to see a pullback. Not only do you have this upsloping wedge pattern, which upsloping wedge patterns are more likely to break to the downside, as well as you have this intraday topping tail. And the thing about intraday topping tails is that when you form a topping tail, and this is a little bit of an education for the members here, I'm going to share some insights. So when you form an intraday topping tail, which is what we have here, you typically get a retrace of 50 to 100%. Now, we got a retrace of more than 100%. We actually negated that pivot. So in the scenarios where you get your topping tail and you have a retrace, but the retrace ends up piercing and breaking that previous pivot on the topping tail, in most cases when you can't hold that high, that breakout, it's what's known as a failed breakout or fake out. So that's what I'm clearly seeing here on the dollar, which is why I think we saw a little bit of a buy program in the indices and particular certain individual stocks in the last 20 minutes of price action. So I'll discuss on the daily basis what I'm seeing with the dollar. You can see you've tagged that resistance and you basically did not get confirmation of the breakout, which likely tells me that we're going to see the dollar pull back in the short term, soften up a little bit, kind of do a little bit of backing and filling before it has its next potential move up to this 110.40 level. Now, I could be wrong. We could wake up to a lot of fear on Tuesday next week, and the dollar could be surging higher, which certainly would put pressure. But the signals that I'm seeing, it puts into the probabilities more likely that the dollar is going to soften and see some downside. Where do I see downside? You're going to have a little bit of support at this pivot low here, but I think due to the fact that you could not confirm a breakout, you're going to see a retrace back to this 107 level, potentially even the low end of this range. Now, one of the reasons I'm also so bearish on the dollar is if we look at gold, and just bearish in the short term. So gold had a pretty impeccable day. Gold was up almost 1% on the day, just closing slightly off of the highs, but beautiful price action on gold. When you factor in how much the dollar has actually rallied in comparison to gold, let me just pull up the dollar again. So the DXY basically closed up near the highs again of yesterday's session, and it did have a little bit of technically a down day, but pretty much flat on the session at the highs. And when you factor in that gold still had a rally despite the dollar still holding its highs, that shows underlying relative strength in the precious metal sector, specifically gold. And it's amazing to see that relative strength because what have we been doing? We have been accumulating gold and silver and miners. And if you look at some of the miners today, like Pan American Silver, beautiful, beautiful bid today, closing nicely off the lows, up 3%. It was up 4 or 5% at the highs. Even if you look at the GDX, you typically want to see the miners leading the metals, and that's certainly what we saw today, another 3% up on the GDX. Look at that ad that we did on the GDX, 23.12, and a beautiful move off of that level. We also have Newmont, which we're slightly out of the money, but again, another strong day for Newmont, up 1.86%. If we look at Newmont, did not put in a reversal signal, but nonetheless, I do think we can potentially see some continued upside just due to the fact that look where we were. We were all the way up here at the invasion, and look at the sell-off in the miners. When you factor in the fundamentals for the miners now that the dollar should be weakening, which should help gold catch a bid, and then when you factor in that mining input costs are now reducing with the lower energy costs that we're seeing with oil coming down substantially, that should catch a little bit of a bid for the miners. But nonetheless, beautiful oversold chart. A simple retrace on this stock can at least take you to this gap fill around 51, which would be a heavy gain for us. Taking a look at oil, oil is showing some relative weakness. You had this beautiful 3-day bar surge to a low, found support, hit support, bounced. You were unable to hold this level today, which is slightly a bearish indicator considering you had an oversold bounce and you weren't even able to hold the highs. Shows that there's underlying weakness in oil. Nevertheless, it was a positive day. What I think we get for oil is a little bit of consolidation before breaking lower to this 76 level. That 76 level is probably going to coincide with this upsloping trend line. This was our megaphone pattern that we were watching for quite some time, and I do think oil can potentially see a convergence of these two trend lines. Maybe in and around October we see a low here, 76. Now of course oil could drop before that and pierce this orange line and head to this, but there's a lot of support in close proximity around this orange trend line, which is this beautiful high here, your consolidation zone before breaking down, and your consolidation zone for before breaking up, as well as this upsloping support line. So lots of support there for the oil trade. I may consider going long. If we take a look at natural gas is an interesting chart. If we take a look at natural gas is an interesting chart. We have been seeing distribution patterns. That's all we've been talking about. I feel like a broken record because natural gas is just kind of luring and roping investors in here before it has a leg down. Kind of like what it did here where it looked like it was consolidating to make a sharp move up, and then look what happened. Boom. Consolidation, boom. Consolidation down. Consolidation down. And just this type of move shows you the fear of how fast selling can occur in this commodity, just the volatile swings. And that's certainly what I'm seeing. You failed to close above this previous daily topping tail. You failed to close above this previous reversal candle. And you also on the larger time frames, the weekly and the monthly, you failed to close above all of the reversal signals, which shows to me on a technical basis resistance is still intact. If you keep failing to break out of resistance on all major time frames, the medium, the short, and the long term, then the probabilities dictate downside is likely to come sharply. Your key levels that I'm watching for support, you have minor support at 828, intermediate support at 750, and then your major support here around the 630 level. I haven't decided where I'm going to cover my short. It's all going to depend on a rate of change calculation that I'll do as soon as I see the price action occur. But again, more downside. We're deep in the money on our KOLD already netting a double-digit gain. So even just a move down to here will put us up 20%. A move down to here will probably put us up 30, 40%. If we hold down to here, we're probably looking at like 50 to 70% gain on our KOLD. So again, I haven't decided how much, but I do think we can get a sharp move on natural gas to the downside. And one of the reasons I'm bearish on natural gas is if you simply look at what type of news the natural gas market got today, the natural gas market received news that Putin was shutting down the Nord Stream pipeline again and choking off the natural gas supply to Europe. Now, we've heard this headline numerous times, but the fact that the most bullish headline is still not getting positive price action for natural gas just shows you that all this news and these headlines are roping in smaller retail money who think this natural gas trade is going to make them this moonshot profit, and when in reality the news isn't even moving the natural gas prices in a positive direction, which is kind of a negative divergence when you look at the fundamentals and the news that's coming out. You would naturally expect for that type of negative news to propel the price higher or at least give it a positive close, but it was still down on the day about 3%. It was down around 5% at the lows. So again, just sit tight with natural gas. Much more downside is to occur. The interesting thing about this type of price action is you've had your lowest daily close since basically over here, this green candle. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days, 12 days of price action. We've had our lowest daily close. If we look at it on a weekly basis, Same type of thing on a weekly basis. This is your lowest weekly close in 1 to 2 weeks, basically. So not healthy price action in my opinion. Looking at the weekly basis, look how fast these 3 weeks of downside occurred. I think we're starting to see the first signs of what we saw here, where you had your 2 weeks of consolidation before you had your big move down. You're kind of having a consolidation. You may have another one, and then we could see a sharp move down in the natural gas. And natural gas, if you analyze the fundamentals of natural gas, Eurozone is pretty much stocked and ready to go for the winter. There's a lot of chatter about, oh, this is going to be a rough winter, it's going to be so painful, but in reality, if anyone actually studies the natural gas markets and takes into account inventory levels, which I monitor on a weekly basis, you will know that the EU is well prepared for this winter. And when you factor in that most of the reserves are stocked and ready for the amount of demand and consumption, that is certainly a positive sign if you're bearish in natural gas in the short term. Now, the real issue is going to actually be the next heating season, not this next one, because when you factor in that Europe is still going to be using Russian natural gas this heating season in energy, because their reserves started to stock up before the sanctions took place. So this winter, they're still actually technically using Russian natural gas. It will only be the next winter stockpiling season, which will start sometime early next year, when the natural gas will no longer be coming from Russia unless Europe bends and breaks on the back of the sanctions. So this winter, they're still using technically Russian natural gas because they were stockpiling before the sanctions. So next winter is going to be the real struggle if the Russians will keep the pipeline closed and refuse to ship natural gas to Europe. That's when you can see a massive spike, because then you'll have a real supply crunch. And if they haven't adapted and implemented new policies, then there's certainly no way that the infrastructure will be ready to even supply Europe with as much natural gas as they need. They will have to switch to coal. They will have to switch to wood, which is taking them back to basically the 19th century. So never a good thing for Europe. You know, my thoughts and prayers are with them, but this is all political on both sides. If you're supporting one side of the war, you know, that's kind of crazy. No one should be supporting any side of the war. It's all bureaucracy, it's all craziness, and it's not good for anyone. It's not good for global trade. It's not good for the lives that are lost. And the amount of poverty worldwide that this war is creating is certainly more of a death toll over the long term than any war is going to create. So the fact that deglobalization is occurring is never a good sign for basically any emerging market, any developed market. It's just a whole round mess for everybody, and I don't support any side because war is never a good thing. And if people just came to an understanding and truce, maybe and actually studied history, maybe there would be some sort of a resolution that would have occurred already. Certainly there hasn't been really any olive branches extended from either side, which I think that puts all sides at fault there. So nonetheless, before we get into too much politics, price action in natural gas is certainly distributing bearish signals, in my opinion. If we take a look at the US 10-year yield, so the US 10-year yield is interesting. One of the reasons why I was, again, a third factor. So the first factor why I'm bearish on the dollar and think equities are going to get a bounce is because the US dollar failed a breakout, failed to confirm, put in a little bit of an intraday reversal signal. The second factor was the fact that gold still was able to hold its rally despite a very strong dollar holding near the highs. And the third factor is this, interest rates. So the yields, despite pulling back, the dollar still rallied. Typically when yields are pulling back, the dollar softens. Typically when yields are rising, the dollar rallies. So as the yields have pushed back, the dollar was still rallying, which is kind of why I was suspicious of this last rally in the dollar. Because as yields are falling, that becomes a headwind for the dollar. When yields are rising, it's a tailwind. And when you look at this exceptional, incredible move in the bond market, the yield market, you know, the fact that we were trading at 2.5 and we're all the way up to 3.3, that's an astonishing move in the credit markets and never healthy to see. But since yields look to be softening and pulling back, that will be a little bit of a headwind for the dollar, which is my third reason as to why the dollar is likely put in a near-term top. So that's it for today's analysis. Overall, I'm expecting a little bit of upside in the markets, which we're certainly positioned to capitalize quickly. If we get that bounce, we'll look to unload some of our long trades. But again, I do think we're primed to see a potential bounce in equities when most people are now turning bearish. If we look at the daily chart on the S&P, a lot of people have turned bearish because we put in this beautiful sell-off, you hit support, you had a nice retrace, you put in this beautiful reversal candle yesterday, and then you completely negated almost 100% of all those gains from yesterday. So that is scaring a lot of investors, but again, it's not really scaring me because we're still at technical support, and the factors that could drive this market higher are simply the dollar trade. And I do think I'm seeing more signals on the dollar that can give equities a little bit of a bounce before inevitably rolling lower. So what I think could transpire is I think we could eventually trade up to this 200-day moving average or potentially this 50-day, whichever one comes first, before starting the next down leg. But the next down leg in the markets will start pretty sharply, especially since quantitative tightening started in September, and in and amongst the amount of 90 billion a month is being reduced and withdrawn from the system. Keep in mind, we printed 120 billion a month for 18 months straight, so 90 billion a month isn't even fighting fire with fire. We're still technically being more dovish than when we were more aggressively printing. So 90 billion a month, although is a lot and will have a lot of detrimental impact on the markets, it generally takes about 2 to 4 weeks for us to see that balance sheet roll off and those bond maturities to mature. So I'm expecting if QT actually starts September 1, I'm expecting those ramifications and impact to only occur in mid-September to late September. So let's continue to monitor the price action. Overall, fantastic jobs. It's always beautiful to end a weekend with 3 winning day trades in our pocket that everyone could have executed and actually banked on. And the fact that we're trading at new highs on our swing trading account, give yourself a pat on the back. It's awesome to know that we have been profiting tremendously in this market. And I think there's still a lot of action to come in the last 4 months of this trading session. So stay tuned for more price action. Thank you all for being members. Hope all this analysis helps. I'm trying to put as much educational material into it, but again, I'm a pure technical analyst. My strategy is analyzing, it's called the stacked methodology, STACT, that is trademarked, but the stacked methodology is an acronym. It stands for sentiment, technicals, analytics, change, and time. Those are my factors that I always incorporate into a trade before executing and making an investment or trading decision. And I will certainly be releasing a educational course that'll teach you this methodology. But at first, I'm fine-tuning it so that it's ready to go and has all the kinks worked out, as I'm also back-testing some of the strategies to make sure that it is completely refined and completely accurate for people to learn. And overall, if you have been watching my videos since the start of the year or following alongside over the last few months, you've probably noticed a lot of things that I observe and do when I trade. But again, I will be putting it into an educational package where people can learn, because I do think learning is everything, teaching is everything. That's why I've been making free videos every day in 2022, trying to help investors and traders navigate these markets, because I don't think we're out of the woodworks. I think this downtrend has just started getting legs underneath it. Typically what you see in bull markets is you see at the biggest moves come at the end of the bull market. Well, the same holds true for bear markets. The biggest moves come at the end of the bear market. So if that holds true, we still have a lot of downside ahead in these markets, which is certainly going to be a scary thing for investors and traders if they don't know how to trade volatility and position themselves correctly according to the overall trends and money flows. So that's it. Please give this video a big like down below, and we'll see you on the charts next Tuesday, as it is Labor Day long weekend. North American markets are closed on Monday. So again, probably coming back to a lot more volatility and volume, which I will be happy to see because it will give us a better sense and true direction as to where the markets are going. This type of float up was on light volume. You can already see the heavy volume starting to pick up to the downside. So it's just about 100 million shares traded on the SPYs today, which is starting to pick up. So overall, congratulations, and we'll see you on the charts next week. Thanks, everybody.